On January 29th, 2026, silver hit $121.64 per ounce. 3 days later, it cratered 30%. Your exit doors are now legally locked. COMEX Rule 589 is active. Most people believe this is a healthy correction, a buying opportunity, a chance to accumulate at a discount. You see, that's the trap. This isn't a correction. It's a liquidity extraction. The system isn't breaking, it's functioning exactly as designed. The goal is to flush retail weak hands before the physical vault inventory hits zero. And the math shows we're 72 hours from that exact moment. The mechanism was built into the exchange rulebook on page 463, Rule 589, special price fluctuation limits. The law was passed decades ago, buried in the fine print, and activated the second silver crossed $120, which means the moment you needed liquidity the most, the system froze your capital. Today, I'm breaking down the three-stage trap, Rule 589, the UCC Article 8 ownership loophole, and the February 9th financially settled futures contract designed to absorb demand without touching metal. By the end, you'll understand why your broker can't get you out, and why that was always the plan. A mandatory protocol before we open the file. This is not financial advice. I'm not a licensed advisor. The math follows a script, but your capital is your responsibility. Always conduct your own research. The date is February 1st, 2026. Silver is trading between $85 and $90. You're sitting on a position that's still up 40% from where you entered. You want to lock in profits. You click sell. The order doesn't fill. You refresh. You try again. The screen says monitoring period active. 5 minutes pass. The price gaps down another $4. You try to sell again. Same message. Another 5-minute freeze. By the time your order executes, you've lost 11% in 23 minutes. You didn't experience a glitch. You experienced Rule 589. COMEX Rule 589 implements what the exchange calls special price fluctuation limits. The rule states that if silver moves beyond a predetermined threshold above or below the previous day, a settlement price, the exchange triggers a mandatory monitoring period. Trading halts, price discovery pauses. Your capital is frozen while the market gaps against you. The threshold increments in stages. First limit, $3, which means in a true panic, the market can freeze for 15 minutes or more while your position bleeds. You see, the rule was designed for orderly markets, to prevent flash crashes, to protect against algorithmic chaos. That's the official narrative. The forensic reality is different. Rule 589 protects the clearing members, not you. It gives the exchange time to adjust margin requirements, liquidate over-leveraged accounts, and manage systemic risk. Your sell order is secondary to the institution's survival. Plus, the rule only activates during high volatility, which means it triggers exactly when you need to exit the most. On January 30th, silver dropped $18 in 6 hours. Rule 589 fired 3 times. Retail traders were locked in. Institutional desks had direct access to the clearing system and exited before the halts. The trigger for this collapse wasn't random. On January 27th, President Trump nominated Kevin Warsh for Federal Reserve Chair. Warsh is a known dollar hawk. His nomination signaled a policy shift toward currency stabilization. The dollar rallied. Commodities sold off. Silver, which had gone parabolic on inflation fears, reversed violently, which means the exit you planned for was never available. The system allowed you in at $70. It allowed you to ride it to $121. But the moment the trade turned, the rulebook activated. You became trapped capital. If this mechanism just clicked for you, or you want to track these liquidity traps as they activate in real time, join the Forensic Circle by hitting subscribe. We hold ourselves to a different standard here. Let's move to the deep dive. But Rule 589 is just the surface lock. The real trap is buried 3 layers deeper, in a legal code most traders have never read. It's called UCC Article 8, Section 511, and it doesn't just freeze your exit, it erases your ownership entirely. The law is Uniform Commercial Code Article 8, Section 511, priority among security interests and property interests, adopted in all 50 states, embedded in the commercial framework since 1994. You've never read it, your broker never mentioned it, but it governs every ounce of silver you think you own. Here's what it says. If your broker or custodian becomes insolvent, the secured creditors have priority over you. You are not the owner, you are the entitlement holder, which means you hold a contractual claim to silver, not the silver itself. The distinction is mathematical. Ownership means you possess the asset, you control it. You can take delivery. An entitlement means you possess a promise, a ledger entry, a right to request the asset, assuming the counterparty survives. You see, when you buy silver through a brokerage account, which means your silver isn't yours, it's collateral for someone else's debt. Let's apply this to the current COMEX vault structure. As of February 1st, 2026, COMEX registered deliverable silver inventory stands at 124 million ounces. That number has dropped 117 million ounces, 22% since September of 2025. 117 million ounces gone in 5 months. You see, COMEX divides its inventory into two categories: registered and eligible. Registered metal is available for immediate delivery against futures contracts. Eligible metal is stored in the vault but not allocated for delivery. It's off limits unless the owner converts it to registered status. The registered pile is shrinking fast. September 2025, 533 million ounces registered. December 2025, 291 million ounces. February 2026, 124 million ounces. The math is a countdown. At the current rate of depletion, the registered inventory reaches zero by mid-March, which means the exchange has 42 days before it cannot fulfill physical delivery requests. Plus, the open interest on COMEX silver futures is currently 876 million ounces. If just 15% of contract holders stood for delivery, the system would collapse instantly. The metal doesn't exist, which means the exchange needs a release valve, a way to absorb demand without touching the physical stockpile. On February 9th, 2026, the CME Group launches a new contract, the 100-ounce silver futures contract. Ticker symbol, SIF. The fine print states it is financially settled, which means when the contract expires, you do not receive metal. You receive cash. The settlement price is determined by the COMEX spot price at expiration. You are paid in dollars, not ounces. The contract is designed to redirect retail buying pressure. Instead of draining the registered inventory, the exchange offers you a paper proxy. You get price exposure. The vault stays intact. You see, this is the same mechanism used in the gold market with the GLD ETF. The fund holds physical gold, but the shares are securities. When you buy GLD, you are not buying gold. You're buying a claim on a trust that holds gold. If the trust fails, you're an unsecured creditor. The metal belongs to the custodian's lenders. The SIF contract applies this exact structure to silver futures. You think you're trading metal, you're trading a derivative of a derivative. And if the clearing member defaults, UCC Article 8.511 activates. Your claim gets wiped. Let's walk through the cascade. Step 1, silver goes parabolic, retail piles in. The registered inventory drains as contract holders demand delivery. Step 2, the exchange activates Rule 589. Trading halts, price discovery freezes. Retail is locked in while institutions exit through back channels. Step 3, the price collapses. Margin calls trigger. Overleveraged accounts liquidate. The broker seizes your position to cover the shortfall. Step 4, if the broker itself is insolvent, UCC 8.511 activates. Your entitlement is subordinated to the broker's secured creditors, the big banks, the clearinghouses, the prime brokers. You're left holding a bankruptcy claim, not silver, a claim. And the payout is pennies on the dollar, settled in 3 to 7 years, which means the metal you thought you owned was never yours. It was the bank's collateral. You were renting exposure. This gets darker when you layer in Dodd-Frank Title II, the Orderly Liquidation Authority. Dodd-Frank Title II allows regulators to seize a failing financial institution and restructure it without a formal bankruptcy. The law was passed in 2010 after the Lehman collapse. The stated purpose was to prevent taxpayer-funded bailouts. The mechanism it created is called a bail-in. Here's how it works. If a bank or broker-dealer is deemed systemically important and faces insolvency, the FDIC steps in as receiver. Unsecured creditors, including depositors and entitlement holders, are converted into equity. Your cash becomes shares in a bankrupt institution. Your unallocated silver becomes the bank's asset. You see, under Title II, unallocated assets are treated as general liabilities. You do not have a segregated claim. The metal is pooled. And when the bail-in is executed, the pooled assets are used to recapitalize the institution, which means your silver is legally reclassified as the bank's property. You're issued stock in a restructured shell company. The metal itself is sold to satisfy the creditors. The precedent was set in Cyprus 2013. The government seized depositor funds to recapitalize the banks. Accounts over 100,000 euros were converted to equity. Depositors lost 30 to 40% of their capital overnight. The law is already written. It's sitting in the federal code, waiting for the next systemic shock. Plus, the commercial real estate maturity wall is hitting in 2026. Over $1.5 trillion in CRE debt is coming due. The default rate is already climbing. Regional banks are overleveraged. If the cascade begins, Dodd-Frank Title II becomes the playbook, and your unallocated silver, the silver sitting in your brokerage account, becomes part of the bank's balance sheet. The convergence is mathematical. The registered inventory is depleting. The new financially settled contract launches in 8 days. The The legal framework for confiscation is already active, and the clearing members know the timeline, which means the exit you're planning doesn't exist. Rule 589 locks the door during volatility. UCC 8 of 511 erases your ownership if the broker fails. Dodd-Frank Title II converts your metal into equity if the system cracks. You're not trading silver, you're trading a security entitlement governed by bankruptcy law, and the contract you signed, the one you didn't read, subordinates your claim to the institution's survival. The clock is now visible. The inventory is draining. The trap is closing. But this mechanism isn't new. The script has been run before, twice. Once in 1980, once in 2011. Both times, silver hit $50. Both times, it collapsed overnight. And the pattern that governed those collapses is now repeating with surgical precision. Historical parallel. 1. March 1980. The script has been run before. March 1980. Silver hit $50 per ounce. The Hunt brothers had cornered the market. They controlled over 100 million ounces of physical silver and held massive futures positions on COMEX. The squeeze was working. The vaults were emptying. The system was breaking. Then the exchange changed the rules. On January 7, 1980, COMEX implemented Silver Rule 7. The rule restricted new long positions and raised margin requirements to 100%, which means you could no longer buy, only sell. The Hunt brothers were locked in. Their positions became forced sellers. The price collapsed, $50 to $10, 80% in 8 weeks. The Hunts lost over $1 billion. They filed for bankruptcy. The exchange survived. The clearing members survived. The retail traders who followed the Hunts into the squeeze were liquidated. You see, the mechanism was identical to Rule 589. The exchange waited until the price went parabolic. Then it activated emergency protocols, trading restrictions, margin hikes, forced liquidations. The system flushed the weak hands and reset the market. The official narrative called it market stabilization. The forensic reality is wealth transfer. The Hunts were removed, the institutions recapitalized, and the precedent was set. When the exchange faces existential risk, the rulebook rewrites itself. Historical parallel 2. April 2011. The pattern repeated 31 years later. April 2011. Silver hit $49.80. The rally was driven by post-financial crisis fear, quantitative easing, currency debasement. Retail investors piled into precious metals as inflation hedges. The registered COMEX inventory was draining. Physical demand was surging. The backwardation signal appeared, futures trading below spot, a classic squeeze indicator. Then the exchange intervened. On April 25, 2011, CME Group raised margin requirements on silver futures by 84%. Overnight, no warning. Traders who were leveraged 3-to-1 suddenly needed to post 3 times the capital. Margin calls triggered, positions liquidated, the price collapsed, $49 to $26, 47% in 9 days. You see, the catalyst wasn't a change in fundamentals. It was a change in the rules. The exchange used margin as a weapon. It forced selling at the exact moment when buying pressure was highest. The retail crowd, which had entered at $35 to $45, was wiped out. The institutions exited at the top and re-entered at 26. The cycle is mechanical. Allow the rally, drain the inventory, then change the rules to trigger liquidation, reset the market. Repeat. The 2026 reality, the parabolic peak. Now apply this pattern to 2026. Silver opened January at $73. By January 29th, it hit $121.64. That's a 66% gain in 29 days. The rally was driven by 3 converging forces: the weakening dollar, inflation expectations above 4%, and the registered inventory collapse at COMEX. The setup was identical to 1980 and 2011: parabolic price action, retail euphoria, inventory depletion. The system was approaching a breakpoint, which means the exchange faced a choice: allow the squeeze to continue and risk a delivery default, or activate the emergency protocols. They chose the protocols. Rule 589. Margin hikes, trading halts. The SAF financially settled contract launching February 9th. The price has already collapsed 30% from the peak. Silver is now trading between $85 and $90. The weak hands are being flushed. The inventory pressure is being redirected into paper contracts. History doesn't repeat, it rhymes. And the rhyme scheme is now visible. But why now? Why is the liquidation happening in 2026 specifically? The answer is the commercial real estate maturity wall. Over $1.5 trillion in CRE debt reaches maturity in 2026. Office buildings, retail centers, hotels. Most of this debt was originated in 2016 and 2017 during the zero interest rate era. The loans were structured as 10-year interest-only notes with balloon payments at maturity. The assumption was simple: rates would stay low, property values would rise, and the loans would be refinanced at favorable terms. The assumption failed. Interest rates spiked. The Fed funds rate hit 5.33% in 2023. Refinancing became impossible. Property values collapsed as remote work gutted office demand. Vacancy rates in major cities hit 20 to 30%, which means the borrowers cannot refinance, they cannot sell, and they cannot pay the balloon. The default wave is beginning. Regional banks hold the majority of the CRE exposure. Their loan portfolios are underwater, the capital reserves are eroding, and the regulators are watching the same math we are. You see, when banks face a liquidity crisis, they liquidate their most liquid assets first. Treasuries, equities, commodities. Silver is a tier 1 liquid asset on institutional balance sheets, which means it's being sold to raise cash before the maturity wall hits. Plus, the banks know the precedent. If the CRE defaults cascade into a systemic event, Dodd-Frank Title II activates. The FDIC becomes the receiver. Unsecured creditors get bailed in, and the institutions that survive will be the ones with cash, not metal. The liquidation of silver isn't a market correction. It's prepositioning. The institutions are converting volatile assets into dollars before the restructuring begins. The registered deliverable inventory at COMEX is 124 million ounces. The open interest on silver futures is 876 million ounces. That's a ratio of 7 to 1. For every ounce of physical metal in the registered vault, there are 7 ounces of paper claims. If 15% of contract holders stood for delivery, the exchange would need 131 million ounces. The vault only has 124 million. The system would default, which means the exchange cannot allow a delivery squeeze. The CIF financially settled contract is the escape hatch. It redirects demand into cash settlement. No metal moves, the vault survives. But the inventory is still draining. Eligible metal is being withdrawn. Registered metal is being delivered against expired contracts. And the inflow has stopped. The countdown is visible. At the current depletion rate, the registered inventory reaches 0 by mid-March. That's 42 days. You see, the Hunt brothers collapsed the system from the outside. They tried to corner the market through brute force buying. The exchange stopped them by changing the rules. The 2026 squeeze is different. The system is collapsing from the inside. The inventory is gone. The maturity wall is forcing liquidations. And the legal framework, Rule 589, UCC 8511, Dodd-Frank Title II, is already activated. The trap isn't being set. It's already sprung. The convergence is no longer theoretical. The inventory is depleting. The maturity wall is here. The legal mechanisms are active, and the institutions are exiting while retail is still trapped inside the paper contracts. The final moves are now imminent. Most people will ignore this data and pay the price. They'll believe the headlines. They'll trust the broker. They'll assume the exit doors stay open during a crash. But if you're the type of person who refuses to be a victim of the script, if you study the fine print instead of the headlines, join the forensic circle by hitting subscribe. We hold ourselves to a different standard here. The next autopsy is already in progress. The February 9th SIF contract launch, the March registered inventory depletion, the CRE maturity wave hitting regional banks. These aren't isolated events, they're stages in a sequence. Make sure you're subscribed so you don't miss the reveal when it drops. The market is engineered to transfer wealth from the emotional to the rational. The emotional trader sees a 30% correction and calls it a buying opportunity. The rational trader reads Rule 589 and understands it's a liquidity trap. The emotional trader believes they own silver. The rational trader reads UCC Article 8511 and knows they own a claim. The emotional trader waits for the system to recover. The rational trader positions before the registered inventory hits 0. The convergence is no longer approaching. It's here. The inventory math is visible. The legal mechanisms are active. The maturity wall is forcing the cascade. The moves are imminent. The system rewards those who read the script, not those who trust the narrative. The next 42 days will separate the two. Position yourself on the winning side.